Hey, well, hey, welcome back to the Presidio Perspective. I'm Dustin TenBroeck. Here with me, as always, Jeff Anderson, and we have a brand new agenda for you for the show today, other than what we had about 12, 24 hours ago. But that's just kind of what we have to do here on the Perspective. Things move pretty quick, huh?
Yeah, they sure do.
So, we were going to start off, wanted to quickly touch upon the Russian aggression and Russia-Ukraine situation that has obviously taken a big turn today as we are recording this on Thursday afternoon after the markets close. So that definitely dominated the storylines and the headlines of the day, and the market went on quite a wild ride.
It did, but I think before we get into that, I think it's kind of important to kind of take pause and acknowledge that this invasion is tragic. Their lives are going to be lost, and lives are going to be permanently altered, and it's just it's a tragic thing. And I know we're going to get into all the implications in the rest of the podcast, but it's just it's sad.
Yeah, it is sad. Absolutely. It kind of seems a little trite to be sitting here talking about what's going to happen in the markets and interest rates. Of course, that's our job, and that's what we're qualified to speak on. But I had the same thoughts, coming into work today, listening to the radio and, listening to some of the interviews with those citizens in Ukraine and how their lives are altered, and, listening to this mother who was going to make sure that her 16 and 10-year-old sons were bunkered down and safe, and she was going to go join the reserves and armed forces, and never held a fire weapon, before in her life, had no training, but that's life now over there for a lot of people, and it is truly sad.
I can't even imagine.
Yeah, and that is the nice thing about being here is we don't have to imagine that so often. But,
right.
But it is happening, and there is implications that are going on. People are concerned about their portfolios. We were just joking a moment ago, like most people aren't glued to the stock market all day long like you and I are. Right? I mean, it's the first thing we do, 6:30 a.m. We're on the West Coast. We're looking at the market open. We're looking at what they're doing. We're looking at the futures, the night
Right.
before and the morning before that, and we're watching it throughout the day. We finished at unbelievable highs today. Not highs, but like a big reversal. I mean, the markets opened down deep in the morning. The NASDAQ was down 3%, finishes up over 3%. A 6.3% move intraday. I mean, that's pretty. That's a pretty monumentous move. I don't see that too often.
In your retirement 101 courses, you talk about that medium-term bucket getting 6% rate of return over a year, and
Yeah.
if you bought it on the lows today, you're done.
Yeah. No kidding. That's a day in the market, and a lot of people, I'm sure, made the wrong decision, right, early on, because there's a lot of fear out there.
Sure is.
But, well, before we get into what the markets did today, because I do want to touch upon that, I think that's really important. I learned a lot watching the markets today. I want to share my perspective on that. But let's talk a little bit about what are the economic implications here. We have Russian aggression invading Ukraine. We could talk about the geopolitical reasons there. This wasn't out of left field. This is something that's been going on for quite some time. You could argue 30 years, 7 years, but there's been a chess game being played, right? And we kind of knew how this game was going to manifest. But, what are the economic implications that we're facing now?
Well, I think the main one is energy. Mm-hmm. Russia's a energy exporting country, and 60% of their exports are energy, and they supply most of the gas to Western Europe. Germany is really dependent on natural gas coming from that region. So, we have spent, you think about living in California, and we've always been kind of a climate-friendly, leading-edge technology, moving green, but that process takes decades to wean ourselves off of liquefied fossil fuels, hydrocarbons, into green energy, wind, solar, and you still need baseload power, and right now that's nuclear.
Yeah.
So we're investing there with climate policies, especially in Europe, and trying to get off of oil and gas. We're underinvesting,
right,
while we make this transition. We haven't quite gotten the scale we need in green energy, so there's this kind of ugly pocket where we don't have enough of one, we haven't invested enough in the other. So
I know where you're going with this. So we're still dependent on fossil fuels, and we're seeing it at the pump. We've seen oil pushing $100 a barrel. Right, and Germany and other Western states in Europe have made a big push into green energy, which has made them pretty dependent on the natural gas supply that they're getting from Russia.
Right.
And they have underdeveloped what they have to run their own energy power grid consumption. And so they have a lot of dependency on Russia for that energy export.
Right.
So they're imposing sanctions, right? And now here's the chess game that's being played. And I was talking to you before. I mean, I just think of this as like everybody's still playing those initial moves in the beginning of a chess game. I know you play a lot of chess, right? And we wait for the white to move.
Right.
We look at what that first move is. And we go, okay, it's going to be that kind of game. And we all kind of just know what we're going to have to do. Okay, I match your pawn with my pawn. I move out my rook. Your pawn takes my pawn. I take your pawn back with my rook. I move the bishop out to attack, and we know the first 10, 12, 15, and then it starts getting murky. I feel like everything that has gone on up to this point, and I think you made that point as well, it seems like those first few moves, and now we're kind of getting to the end of the beginning of the game and going to see how it goes from here.
Right.
It's not like Putin was shocked that we're putting sanctions on him for invading Ukraine.
Yeah.
It was a calculated move. We knew the response, right?
And he prepared his country for it monetarily.
For the last 7 years, arguably.
Yeah.
So how did he prepare his country?
He bought a lot of gold. He sold his U.S. treasuries.
You said how much gold did he buy?
Well, I think they have something like almost $300 billion of this is a $1.4 trillion GDP country. So that's a meaningful amount of gold.
Yeah.
On a percentage-wise, it's higher than anybody else. They sold their treasuries, and they bought IMF special drawing rights, which is like a basket of securities that he was preparing for being sanctioned long before this happened. So it started with Crimea. It is a long, calculated chess game that, as you said, just got past the easy moves, and now kind of this is where the rubber meets the road. And so we could be dealing with this for a while. I mean, where, at some point it won't be in the news, just like Omicron, in terms of all the tragedies that are happening within the Ukraine. But how Russia sees itself and fits itself into the world economy is we're starting to see it. So
yeah, I mean, there's no world war happening right now.
No.
When people talk about World War III, I've heard, just seen some posts and call outs for that. Obviously, there's always that fear and wall of worry in the news, and that's a little way overblown, right? That's not happening. Ukraine isn't part of NATO. They're not attacking a NATO country. We wouldn't defend a non-NATO country. So all of that was part of the chess game, right? We kind of knew that was susceptible. And if you're Russia and you want to be on the world stage as a legitimate global superpower, and you have your enemies to the west that have this nice bordering country that's maybe less sympathetic to yours, creates a nice cushion for your potential enemies. Yeah, if you're Putin, you're like, well, we're going to go and regain and reclaim our old Soviet Union back. I don't even think that's the story. I don't even think it's really, and who knows, right? This is kind of outside of my expertise, but, yeah, sure, maybe he has a vendetta to go put it all, get the band back together again. But, just like you said, when they got Crimea, annexed Crimea, like that was very strategic. It's a port town, right? I mean, it's a very strategic location, and so is Ukraine. And so if you want to be on that global superpower and throw your kind of muscle around and know that, hey, we're right next to your allies, you might, your voice is going to seem a little louder on the global stage.
Yeah, it sure is. And
what would you be willing to sacrifice to get there? So I think Putin's calculated all of these risks, right? And this is going to happen. And then we're going to live in the world where Ukraine is, what kind of state is it? And we'll see what the fight is and how long that persists. But it's mainly going to be a Russian problem, I would assume. Yeah.
Yeah, it is. The implications for us, though, are really twofold. One of the implications is oil prices, and we'll get to that when we get into the next segment, comparing 2007 to 2022, and I think that probably got some of the listeners' attention. We put that out earlier in the week.
Yeah, they didn't need any more fear. And then we said, hey, this looks like just like 07. So not just like similarities and differences. We'll get there. But, yeah, we should move on to talk about some of the larger picture. But, in times like this, there's a lot of fear out there. And again, the story is going to continue to unfold and get spun out. I heard a great quote this morning. I was watching the news this morning as Art Cashin came on, long-term trader on the floor. I think you shared some time with him back in the day, right?
20 years ago, I used to see him walk. 22 years ago, I used to see him walk around the floor of the New York Stock Exchange. I thought he was old then.
Well, he was talking about it when he started around 60 years ago. So yeah, he's up there. And his mentor, senior trader at the time, said, "Hey kid, word of advice: never bet on the end of the world. It only happens once, and it's quite a long shot, right?" And if people are fearful about what's going on, I mean, it's just like 2 years ago. Like what? The next time we do this podcast, it's going to be the 2-year anniversary of when we shut down the economy, right? Our next podcast in March. And it's going to be a 2-year anniversary of when we really shut everything down for COVID.
Right.
I can't believe it's been 2 years. But I mean, talk about the resiliency. If you're going to ever say, hey, this time it's different, that would have been a time.
Sure would.
Because it was, right? So a lot of these things we've seen before. So why did the market I mean, again, I'm looking at the NASDAQ today, and we're up over 3%. I'm looking at the S&P up 1.5%. I'm looking at small caps up 2.7%. Small cap growth, right, is up over 4%. What's going on?
Well,
I mean, it was blood in the streets, wall of worry, fear gauge high, sell buttons on, all red this morning, and then what a reversal in the later third of the trading day today.
We never know the exact reason why stocks go up and down in the short term, but the kinds of stocks that had the rallies that they did today kind of calls into question maybe the interest rate policy that everybody's priced in. And we don't know what that, they've been very aggressive, and we talked about this on previous podcasts maybe multiple times. The idea that rates had to go up faster and more of them.
Yeah.
And that started ramping up. We went from 1 to 2 to 7 or 8. And all of a sudden today, the stocks that would be kind of the most affected by interest rates just ripped.
Yeah,
so,
absolutely.
It'll be interesting to see what the market's always ahead of what the news, right? It's always leading. So,
well, what do you say? Sell the news.
Well, they say buy on the rumor, sell on the news. But in this case, it was kind of like sell on the news of the invasion, and then and then on the rumor, and then buy on the news.
Buy on the
news.
So
they're like, okay, well
it's happened.
Yeah.
Right. We have all of these unknowns. Right? There's all these known unknowns. We've talked about this in the podcast in previous seasons, especially when it came to COVID, right? And what's a known unknown versus an unknown unknown, and the impact that has on the market. And we're dealing with, known unknowns right now. Is Russia going to invade Ukraine? Has been the question that's been on for the last, year to date. Right. Is Russia? Answer is yes.
They did it.
That is not an unknown anymore. We know that. We don't have to guess. That's more certainty for the markets.
And we love certainty, right?
And we said, well, if Russia invades Ukraine, what would that force now with monetary policy, right? Now what are we going to do? Tighten monetary policy while we have this conflict? Maybe it's not the right time, right? Maybe that's not going to be the time. So, I think that's what the market saw today. And if you look at the names that were ripping, I mean, they're the, high growth, no earnings, Cathie Wood elite, portfolio
right.
just took off, right? Which tells me, interest rates are not going to be going up as aggressive as they thought. Who knows whether the bond purchase program ends at the end of March? I mean, I think that there's, we've talked about this so many times. Bad news is good news to the market.
Right.
Because here's our parents again, being like, hey, no problem. Here's a little more allowance for you to get through this tough time.
Right. The only fly in the ointment, I think one might argue, is with oil prices staying inflated given the conflict and the uncertainty of Russia and supplying gas, is oil moves, if they stay elevated, could add to inflation. So as the supply chain issues are lessening, the effects of higher oil prices might kind of balance that out. And so we might have higher inflation for a little bit longer. And then still makes it very hard for the Fed not to raise rates. But again, it's not just about raising rates, it's the balance sheet, right? They've got trillions of dollars in liquidity sitting there, and they're winding down their balance sheet by the end of March. The question then is, are they going to start tightening? So there's a difference between not
But it's
purchasing.
how much, right?
Right.
I mean, I think that there's, a double rate hike that was almost for sure, and now probably not.
Right.
I forget, you quoted the odds the last time.
Well,
It'd be interesting to check on what those are now, because I bet you it's come way down.
It may have. We'll have to check that tomorrow morning. We'll have that an update. Maybe I'll include it in the newsletter.
Yeah, I'd be interested. Okay, so everybody can breathe at home who listened to this and looked at the headline. So when we say 2007 and 2022, we are seeing some similarities. I mean, we're seeing some things that are happening right now that we haven't seen since '07.
Right.
Anytime I ever hear a statistic that says not since 2006 or not since 2007, hairs raise up on the back of my neck. I'm like, oh no, right? We've heard a lot of these statistics over the last 5 or 10 years, right? And the markets have been quite favorable. But what are we seeing right now?
Well,
Let's go with the similarities first.
All
like
right.
What's the same?
Similarities leading up to '07 or '08. Well, let's just go back to 2000. So after the dot-com crash and after 9/11, that's when we really started becoming accommodative. We started bringing rates down. The Fed Greenspan started dropping rates. Right. Brought them down, and then started to march those rates higher when the Fed realized that the instability of house price appreciation and just global asset prices and loose lending practices and the overall health of the banks. So they started raising rates and did it about 400 basis points leading into '06, and the housing market peaked around '07. Early '07, Q1 of '07, I think it peaked, and it wasn't until September or October of 2008 before we had our real banking crisis. But so rates were going down, house prices were going up, asset prices were going up, loose monetary policy. We hadn't invented QE at the time or hadn't reinvented it. Rates started going up, started cooling things off. Some of these ninja loans, these no income, no job loans, and these ARMs started having to reset. And all these loose lending.
But so how is that similar to today? Because we got rid of a lot. I would say there's where a lot of the stark contrasts and differences. That's where it starts to break down.
Well, the similarity is simply that interest rates going up. Right. The idea that interest rates are going to go up is going to put a lid on housing.
Okay.
And if you look at house prices, and I've got a chart in here that shows house prices. The median house price at the top was like $257,000, and right now the median, as of the last data point that the St. Louis Fed put out, was something like $411,000. So house prices are higher, but if you were to compound inflation over that time period, you'd be at about $390,000. But that is from a peak. But house prices are high, asset prices are high because interest rates were low.
So you're saying adjusted for inflation, they're higher than they were in 2007.
Yeah.
Yeah.
They
median
are
home price.
Right.
Okay.
To the tune of about 10%.
Yeah.
But when interest rates take that trajectory of stop going down and start going up, that's usually a headwind for asset prices, right? So that's kind of a similarity.
It is. Can I just contrast the differences as you go through these?
Yeah.
Because one thing I'll note on that is, and I don't have the statistic for you, but I think we're all very well aware, is the amount of leverage in the system back in 2006 and 2007. Right, it was a real estate market just fueled with debt on people who shouldn't get a loan. Right, and they were securitized, and the interest swaps were sold off, and there was no hedge, and there's just the notion that real estate was going to go up forever; it would never go down. I had lots of people who were in real estate at the time tell me that to my face, and that was the goal. And we had the president saying, and his predecessor both saying that every American has a right to own a home.
Right. I remember that.
Yeah. Well, that was the pitch.
Right.
And so it was just when that started to break down. Now, that's not where we are today.
No, the banks are in much healthier.
Not only the banks, but the loan to value of homes then. Right. I remember the teacher who was married to the firefighter who bought the $1 million house with no money down. And then after they'd owned it for a year, it had gone up by 10%. So it was up $100,000, and they got a $100,000 home equity line of credit out for that $100,000, and they bought a boat and jet skis.
Seems prudent.
I mean, that story was so common. What was going on?
Right.
I just picked two random occupations that it was going on for anybody, and so that's not what's going on right now.
No.
I mean,
No.
home prices have surged recently, and the covenants on who gets a loan, what the debt levels are, that's one of the big differences, right? Banks are aware of that risk.
Right. And there's not all these credit default swap contracts being moved
Sold
around by
off.
hedge funds
Yeah.
and tranched up to make them look credit worthy when they weren't. So a lot of the loose lending policies, and that was the part I was going to get to, is that's where we differ, right? So
Okay.
interest rate policy moving up is a
Similarity.
but the difference is the health of the banks and the lending standards. The banks back then really didn't have much of an equity buffer. They didn't have the ability to absorb any real correction in any housing price declines, and now they can. Now the banks are in much better shape. It's not that easy to get a loan.
Yeah.
It's still not that easy. Even the documentation is they actually check. They actually verify income. The process is a lot more normal, let's call it. So I think they've learned. I think people know that house prices can go down, and I think there's a little bit of fear in the back of people's minds, and that's probably a healthy thing. So that's kind of the similarity and differences in 07 to 2022 in terms of house prices. Oil prices are something that kind of we discussed with Russia.
Yeah, I mean, this is the last time. I mean, that's definitely one of the similarities. I mean, when you look at the chart, you're like, the last time we saw oil, kind of going up on this trajectory, hitting this slope, it looked exactly like, 06 to 08.
Right, and we had a weaker dollar. And we had oil started spiking, and people would argue. Some people would argue it was oil prices that brought down the economy, and other people will say it was loose lending, and some people say a combination of all the above. But so we had oil prices spike; they went up to 140, right? So if you adjust that peak with inflation, we're nowhere near that level.
Interesting too, though, and you talk about this a lot when evaluating energy companies in the energy sectors, their profitability, is so much better today. So we're probably making more on a $90 barrel of oil than we were at a $140 barrel of oil 15 years ago.
Well, we didn't have as much fracking back then. It was somewhat new.
The technology, the cost has been driving down, right?
Driving down. I read a stat today that the average cost to drill a barrel of oil is below $50. And back
depending on where you do
it. And in some places, some of the fracking areas are much lower, but it was much higher. So as you continue to invest in technology, you're bringing the cost down, so the price of oil can still be very profitable for you at lower levels. Because at some point, high oil prices, what do we always say? What's the best cure for high prices? Is high prices.
High prices. Well, and the other thing that's a similarity is that it was pushing oil up so much, right? Is that we were in a war in the Middle East.
Right.
Right. We were in our own conflict.
Right.
With a high energy producing country at the time.
Right.
So maybe another similarity.
Yep. So that's.
Want to move on from that one?
Yeah. Yeah.
All right. So home prices, we touched upon that.
Yeah.
What about the commercial banks?
Again, we just touched on that, but I think it's important to acknowledge is the state of the banking system. Back in 08, we ended up with a banking crisis, which is really the worst kind of crisis for a market, right? When the institutions that back the economy are not solvent, you've got a problem. That's where the Fed really had to come in and bail everybody out. And they didn't have, they had loan to value ratios of 120%, and right now loan to deposits was like 130%. Now they're at like 70%. So they're trying to loan, but it's not easy to loan, and there's just not as many loans out there. Now there's more debt in the system, but there's also more wealth. So
Yeah, you have to make it all relative, right? And look
Right.
at the loan to value ratios and the capitalization and the reserves. So the banks are stronger, U.S. households are stronger. There's more debt, obviously, but there's more assets, so the net worth is larger for U.S. households, country at large, commercial banks, corporations. So what's different? So here we've come out of COVID. We've had this. The Fed's kind of the wild card in this whole thing.
that's the wild card, and I guess the subset to that would just again be inflation. Not that I want to keep talking about it, but I don't know how we can avoid talking
No,
about
absolutely.
it. We're talking
It's
about
that-
financial markets.
Yeah.
So before we didn't.
Unless you want to talk about taxes or market crashes, right?
No.
I mean, those are the three.
Right.
Just choose which one.
Right. So
Which one's is going to get you?
the Fed before had tried so hard to get inflation above 2% and never could.
Right.
They were more worried about deflation,
Which
And
is
then-
much scarier.
which is much
in my
scarier.
opinion, too.
And then COVID came, and all of a sudden, here we are facing deflation again, and they don't want to stare down that barrel again. So they did whatever measures they could. And a lot of people accuse the Fed of I hear it all the time, Powell and Yellen and Greenspan didn't know what they're doing. They're idiots. I have a hard time believing that they're idiots. I think that they learn from their mistakes. I think they're put in a precarious position. And when you shut down an economy like we did in 2020, what are you going to do? I mean, if you're going to tell people that you can't open up your subway, your franchise subway, those people are going to go under. And,
Talk about sandwiches.
sandwiches,
Yeah.
anything. So the Fed had to provide stimulus and did so. And but right now we have an economy that has fully, well, I shouldn't say fully recovered because there are some issues, but in the whole scheme of things, the consumer has kind of recovered and then some, and in many respects has thrived. And the Fed at this point wanted inflation so badly over 2%, and now we've got inflation or CPI running at 7%, and now they're faced with a new set of tasks or problems, which is how do we keep a stable economy while tackling inflation. So that is going to be, and that's, we talked about
The
it
number
before.
one, right, component of inflation is housing, right?
Right.
When you look at CPI,
Yeah.
isn't like 46% of that number?
Yeah.
But essentially rent.
Right.
What brings rent down?
Lower house prices or higher interest rates.
Lower house prices.
Right.
So, a lot of people are out there in the local real estate market, and in a future episode here, 2 episodes from now, we're going to actually have a local property manager come on and talk about the local housing market and what they're seeing from a rent perspective. But yeah, they have cap rates, right? So
Right.
commercial real estate, residential real estate, how much income do you earn as a percentage of what you would be willing to pay for that property?
Right.
And California is always really low cap rates. It's not a great income asset. It's a growth asset, and so if you're looking at rents right now and you're looking at the price of those homes, it's like a 2 cap.
Yeah.
You get a 2% income stream or worse, right? Because you have expenses that you have to do on top of that thing. So maybe you're netting less than 2% tax and ordinary income. And that's kind of what the market looks like, depending on what kind of home you have.
And that's a function of interest rates and supply.
So
constraints.
either rent's going to go up right now,
or prices will come down.
and so, hold on. We know we go through market cycles. The last time real estate went down, I don't know, depending on where you were, that kind of hit a bottom in 2010, 11, 12.
Right.
So it's been at least 10 years since you've seen even a dip down, right, in your real estate, essentially, here
Right.
locally in Southern California,
Right.
and for the most part across the country. So we go through these real estate cycles. My dad was a real estate broker. He told me 7 to 10 years is just like clockwork. It happens. So just, know that might be on the horizon too.
Right.
So the Fed might say, yeah, sure, we raise interest rates, mortgage rates go up, housing comes down. That's going to help bring inflation. The next big part of that is what? Energy?
Yeah.
Is that number 2? I forget. You told me these statistics not too long ago.
Yeah.
So you have this energy, and so we're going to do what we can. Obviously, the conflict that's going on right now in Ukraine doesn't help that at all.
No.
So we'll see. There's lots of different things that we can do. We'll see about talking to some of our allies are those other countries that, you know, are major oil and energy producers and users, kind
Right.
of see if we can all get on the same page where everybody lies. That's going to be big news in the days, weeks, months ahead, I would imagine.
Well, I would expect domestically the rig counts to go up. I mean, I think we were at 1,100 rigs or something. We're at 500 right now. So you're going to see a lot more rigs put into production, and that'll probably help with oil prices, but not in the near term.
Yeah.
So I think one last thing I'd like to I think we talked about kind of the market correction, corrections in bear markets, right? We talked about what is a correction, and a correction is somewhere between 10 and 20%, and it happens on average every 22 months, and we hadn't really had it since 2020. So we were ripe for that correction, and on average of those corrections that don't lead into a recession corrected about 15%. NASDAQ today at a low, I think, was at 17% from its high, right?
Not today, but
No,
so far year
from its
to
high,
date.
intraday, I think we were down 17% from the high, and we think closed down about 13
You know, it might have been more. It's 17% year to date. When did NASDAQ peak?
in November.
Yeah. So you might have hit a
So
bear.
we might have hit a bear market briefly, but didn't
Yeah.
hold. So
Right.
it'll be interesting. Are we still in correction territory or bear market territory? The first half of the day felt like a bear market,
Yep.
and the second half of the day felt like a bull market. So we'll see what tomorrow brings.
And why does that matter? Why does it matter if we're in a correction or a bear market?
It doesn't.
Right. It doesn't.
You're trying to trick me every time with that
I
question.
do, because I think that's important, because people talk about that a lot.
It's just a label.
Well, the reason why we bring that up is because when the market goes down by 10%, the S&P was down up to 12% this year to date.
Right.
Okay, it's down 10.02 as of today with a little bit of rebound. But, okay, you went down 10 or 12%, and people go, oh my gosh, here it is. It's coming. I knew it. We're going to go down another 10 or 15. I'm going to get out. And statistically, those corrections happen every 22 months. And about 1 out of 9 of them end up in a bear market?
Yeah, it's some number like that.
So
Yeah.
what if you go back the last 50 years, I'm pretty sure it's 1 out of 9, right? What did you say? The last 24 market corrections, we had 5 of them go in. All right,
Right.
so that was 1 out of 5.
Right.
If you go back, that's since 1974. So if you, what is that? Corrections of just any of 10% to 20?
Yep.
Gotcha. And so 80% of the time, right, it doesn't end up happening.
Right.
Okay, so it doesn't end up happening, and you would have sold at a loss. The market would have rebounded, and you go, oh man, shouldn't have done that.
Right.
So the reason we talk about it is because it really doesn't matter. The market goes down. We understand that markets go down temporarily. They go up permanently. You shouldn't be invested in anything in the market that you think is not potentially going to go down in the next year. I mean, that is just part of investing. Over the next 2, 3, 4, 5, we're long-term investors. We have our plan together. We know what our asset allocation models look like. We're aligned with risk tolerance. We have enough fixed income to weather the storm. Heck, maybe even buy low. But news and events like what we're seeing right now, the market just told you. They love it. Bad news is good news, right? And if you tried, and I mean, every time we learned that in COVID too, there was structure fires, riots in the streets, the world economy was shut down, and the market started ripping. It makes no sense. And here we are, we have this act of aggression. People are making all these kinds of crazy, comparisons to Putin and this act of aggression, and the market just rips today off a low, another 6% in the end of the day to finish at a pretty record day. And so you can't outsmart this market. It's time in, not timing.
Yep.
That's important.
We should end every podcast on that.
Yeah. All right. Well, thank you guys for joining us. We'll see us in our next episode 2 weeks from now. Will be the 2-year anniversary of the shut-in orders issued during COVID. I can't believe it's been 2 years. But
Amazing.
We'll take a look at what's happened since, and I'm sure we'll have a lot more news for you on this crisis that we're seeing in Ukraine. But as always, take care, and don't do anything silly. All right. Take care.
Thanks.